All right, let's jump straight into this explainer. Today, we're unpacking a really critical document that is literally going to shape the future of tax practice in Singapore. We are looking directly at the new Singapore Chartered Tax Professionals, or SCTP Code of Ethics and Professional Conduct, which officially hits the ground running in September 2026. Now, I want you to think of this as way more than just a dusty set of rules. It's actually the ultimate playbook for navigating the high-stakes, incredibly complex world of tax practice. Whether you're a seasoned accredited tax advisor, a provisional practitioner, or honestly just someone who relies on professional tax advice, getting a grip on this code is absolutely essential. It lays out exactly where the boundaries are in a landscape where crossing them can literally cost you your career. So think about this for a second. What actually separates a good tax professional from a truly great one? Well, a good tax professional knows the tax law inside and out, right? They can run the numbers, they can find all the deductions. But a great one masters the ethical boundaries. They understand that their real value isn't just in minimizing tax liabilities for a client, but in protecting both their client and themselves from catastrophic legal and reputational risks. Greatness in this field is really about unwavering integrity, especially when the pressure is on. Okay, here is our roadmap for today. We're going to cover 6 key areas: the tripartite anchor, the 5 fundamental principles, standards for tax planning, interacting with IRAs, navigating conflicts and arrows, and finally, anti-money laundering and evasion.
Let's kick things off with Section 1, the tripartite anchor.
It's so easy to get totally bogged down in the spreadsheets and the statutes and kind of lose sight of the big picture. But the code makes it crystal clear right from page 1, tax is not just a math exercise. The whole fundamental purpose of the tax system is to fund public services and keep Singapore's economy and society stable in the long run. So what does that mean for you? It means tax practice is this constant, delicate balancing act between 3 distinct parties: you, the member, the client, and IRAS, the Inland Revenue Authority of Singapore. Obviously, you have a duty to serve your client's best interests and serve them robustly, but you've got to balance that against upholding the reputation of your profession and, critically, honoring your obligations to IRS and the wider public interest. When these 3 interests start pulling in completely different directions, this code is exactly what keeps you grounded. Moving right along to Section 2, the foundation, the 5 fundamental principles. So these 5 fundamental principles are actually adapted from the global standards of the 2025 ISBA handbook. We've got integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Now, why do these matter so much? Because they absolutely aren't just nice-to-haves. A breach of any of these principles isn't going to result in just a little slap on the wrist. We're talking severe disciplinary action, up to and including being completely removed from SCTP membership. You lose your credentials, you lose your livelihood. It's that serious. The anchor of this whole list is integrity. The code defines it pretty simply: being straightforward and honest in all your professional and business relationships. But practically speaking, in the real world, it means you must never, ever knowingly associate yourself with information that is false, misleading, or just provided recklessly. And here's the real kicker. If you find out after the fact that you've been associated with misleading information, you have to take immediate, active steps to disassociate yourself from it. You absolutely cannot just look the other way. All right, next up, Section 3, the strategy, standards for tax planning. This right here is the ultimate red line. On one side, you have lawful tax planning. That means it has a credible basis in law. You've done your homework, checked the case law, looked at IRS guidelines. It's highly specific to your client's actual facts, and it is 100% transparent. On the flip side, you have tax evasion. This involves highly artificial or contrived structures. It relies on concealment. It completely lacks any real commercial substance, and it's basically just designed to exploit loopholes contrary to what Parliament actually intended. Look, if a scheme relies on hiding things, you are officially in the danger zone. Honestly, I think every tax professional should have this exact quote from the code framed and sitting on their desk. Advice on tax planning must not rely on its effectiveness on IRS having less than the relevant facts. That is your ultimate standard for disclosure and transparency. If you're sitting in a boardroom and somebody pitches a structure that only works if IRS, doesn't look too closely or forgets to ask about that one offshore account, stop right there. That arrangement immediately crosses the line. Let's get into the execution phase with Section 4, interacting with IRS. This phase requires a really clear division of responsibilities. First things first, the taxpayer always has the primary responsibility for making sure their filings are correct. As a tax member, nobody is expecting you to be a forensic auditor. You don't have to independently verify every single crumpled receipt a client hands over to you. However, you absolutely must exercise professional skepticism. If a client hands you numbers that just look totally unrealistic, you have a strict duty of care to ask questions. You cannot present facts to IRAs that you know or even suspect are misleading, and you definitely cannot assert completely baseless tax positions. Oh, and always get your client's written approval before you hit that submit button, for sure.
That brings us to Section 5, the crisis, navigating conflicts and errors.
So things go wrong, right? It happens. But when it does, the code outlines an exact, non-negotiable escalation path. Step 1, establish the facts. Have a frank conversation with the client and figure out if it was just a genuine typo or something a bit more sinister, and document everything. Step 2, you must advise your client to make a full disclosure to IRS, explain the benefits of coming clean voluntarily and the very severe penalties of hiding it. Now, step 3 is the tough one. If the client stubbornly refuses to authorize that disclosure after being warned, you have to consider withdrawing your services. You literally have to cease to act. You cannot continue to represent a client who flat out refuses to correct a known error with the tax authority. And finally, Section 6, the absolute red line, anti-money laundering. It is so absolutely vital to remember this fact. Since 2013, serious tax offenses have been designated as money laundering predicate offenses here in Singapore. What does that actually mean for you on the ground? It means that if you assist a client who is willfully evading taxes, you aren't just an accessory to tax evasion anymore. You could be actively facilitating money laundering. And that instantly triggers mandatory reporting obligations. If you even suspect this is happening, you are legally required to report it to the Suspicious Transaction Reporting Office, or STRO. Let's be incredibly clear about what triggers this. The code categorizes the exact offenses that bring on these money laundering risks. Under direct tax, which is governed by the Income Tax Act, we're looking for things like intentionally omitting assessable income, making up fictitious deductions, or claiming fake dependents. Then under indirect tax, specifically the GST Act, the red flags include claiming fictitious input tax, omitting output tax on local supplies, or producing false expert documents to secure zero-rated supplies. Seriously, if you see these happening in a client's books, you are dealing with potential money laundering. But let's look beyond the legal definitions for a second. The code actually points out the practical, day-to-day warning signs that you need to be watching for. Things like a client flat out refusing to issue sales receipts, or maybe you discover they're keeping two entirely separate sets of accounts. What if you notice massive, unexplained cash movements, or this sudden huge increase in wealth that just doesn't match up with their legitimate business? Where they give you blatantly false information about their suppliers. Guys, these aren't just odd little quirks, they are screaming alarm bells. When you see these, you must step back immediately, report your suspicions to your firm's money laundering reporting officer, and, honestly, you might want to seek some outside legal advice. Well, we've covered a ton of ground today, from that delicate tripartite relationship all the way to the very harsh realities of anti-money laundering laws. I want to wrap up by challenging you to reflect on your own daily conduct. Just ask yourself, is your practice truly built on a credible basis? Are you successfully navigating all the complex demands of your clients, your profession, and the law, and doing it with unwavering integrity? Because at the end of the day, when the stakes are this high, a credible basis is the only foundation that's actually going to last. Thank you so much for joining me for this explainer, and definitely keep these principles front and center in your practice.